Good morning. As the sun rises over the financial district, a sense of anticipation fills the air. Investors and analysts alike are waking up to a market that's taking a breather after a remarkable run. After a period of record-breaking gains that saw major indices reach new highs, Wall Street is now pausing. U.S. stock futures are flat to slightly lower this January 14, 2026, reflecting a market that's catching its breath and reassessing its direction. Investors are stepping back, carefully digesting a wave of fresh economic data, the latest round of corporate earnings, and a flurry of political headlines. Each new report and headline is being weighed for its potential impact on the market's next move. With so much information coming in, market participants are taking time to analyze trends and look for signals that could shape the weeks ahead. This isn't panic, it's a healthy moment of reflection. The market is pausing to reassess its next move, as traders and investors weigh both risks and opportunities in a rapidly changing environment. Stock futures act as a preview of the trading day, and today's flat numbers signal a shift from the bullish certainty of recent weeks to a more cautious, measured approach. The mood is one of watchful waiting. The recent dip was triggered by disappointing bank earnings, especially from the financial sector, and growing geopolitical tensions. These factors have introduced new uncertainty, prompting investors to reconsider their strategies. Now, the market's focus is on whether corporate profits can truly justify the high valuations we've seen, and how new government policies might impact key industries. There's a sense that the next few weeks could be pivotal. Analysts are watching for any signs of momentum, positive or negative, that could set the tone for the rest of the quarter. Every earnings report and policy announcement is under the microscope. As the opening bell approaches, investors are adopting a more analytical stance, waiting to see what comes next. The mood is cautious, but also filled with curiosity about where the market will head from here.
Let's break down the big three indexes and see what's really happening in the markets right now. These indexes, Dow Jones, S&P 500, and Nasdaq, are the pulse of the U.S. stock market, each representing a different slice of the economy and investor sentiment. The Dow Jones Industrial Average, which tracks 30 of the largest and most established U.S. companies, dropped nearly 400 points last session. This sharp decline signals that blue-chip stocks, often seen as stable and reliable, are currently under significant pressure from market forces. Dow futures are down another 145 points this morning, suggesting that caution and uncertainty will likely continue to dominate trading as the day unfolds. Investors are watching closely to see if this downward momentum will persist or if a rebound is on the horizon. The S&P 500, which serves as a broader gauge of the overall market and includes 500 leading companies across various sectors, slipped 0.2%. Its futures are also down by 27 points, reflecting widespread investor apprehension and a cautious approach as new economic data and earnings reports come in. The Nasdaq Composite, known for its heavy concentration of technology stocks, fell 0.1%. Its futures are down 155 points, or 0.6%, which hints at particular pressure on tech giants and growth-oriented companies that have driven much of the market's gains in recent years. This collective dip across all three major indexes shows that the rally which kicked off the year has now hit a significant speed bump. The start of earnings season has brought fresh scrutiny, and especially weak results from major banks have triggered a wave of selling and nervousness. The declines aren't isolated to just one sector. Industrial giants, financial institutions, and technology leaders are all feeling the heat. This broad-based weakness suggests that concerns are spreading throughout the market, not just limited to a single industry. As a result, investors are taking profits, reassessing their portfolios, and rethinking their strategies in light of the new risks and uncertainties. Many are shifting to a more defensive stance, waiting to see how the next round of earnings and economic reports will shape the market's direction. Wall Street's mood has shifted dramatically, from the euphoria and optimism that marked the start of the year to a more cautious, even anxious outlook as the market recalibrates and braces for what's next.
Earnings season kicked off with J.P. Morgan Chase, the nation's largest bank, reporting a drop in fourth-quarter profit. The The decline was partly due to costs from acquiring Apple's credit card partnership, but the report also flagged broader industry headwinds. CEO Jamie Dimon's cautious outlook, especially on net interest income, signaled that the benefits of higher rates may be fading. Most notably, J.P. Morgan warned about President Trump's proposed cap on credit card interest rates, a new regulatory threat for banks. This warning rattled the entire financial sector, sparking a sell-off in bank stocks. The tone for earnings season is now set: caution and uncertainty.
President Trump's plan to cap credit card interest rates has put the banking industry on edge. For banks like J.P. Morgan, Bank of America, and Citigroup, credit cards are a major profit source, and a cap could squeeze margins. Jamie Dimon warns this policy could damage industry returns and force banks to tighten lending standards. That means consumers with lower credit scores could lose access to credit, potentially pushing them toward riskier options. The proposal adds regulatory uncertainty, a major drag on bank stocks. As long as this debate continues, investors will be wary of the financial sector's future.
After J.P. Morgan's cautious report, all eyes turned to Bank of America, Wells Fargo, and Citigroup.
Investors want to see if these banks echo J.P. Morgan's concerns about net interest income and regulatory risks. For Bank of America, the focus is on its consumer banking strength and sensitivity to interest rates.
Wells Fargo's results will be scrutinized for signs of progress in its turnaround and insights into the housing market. Citigroup's global reach means its performance will reflect international trends and currency impacts.
Any commentary on the proposed interest rate cap will be closely watched. The collective results from these banks will set the tone for the sector and the broader market. The next few days are critical for investor sentiment.
Economic data, especially on inflation, is shaping market expectations for the Federal Reserve.
The Consumer Price Index, CPI, showed inflation cooling, and today's Producer Price Index, PPI, could reinforce that trend. Easing price pressures would support the case for Fed rate cuts later this year. The market's recent rally is built on hopes for lower rates, which boost stocks by making borrowing cheaper. According to the CME FedWatch tool, traders see a 95% chance the Fed holds rates steady this month, but cuts remain likely later in the year. The inflation outlook is the market's main long-term positive, even as bank earnings cause short-term jitters. Investors are watching these numbers closely for clues about the Fed's next move. The macroeconomic backdrop remains supportive for stocks.
The Federal Reserve is facing unprecedented political scrutiny as the Trump administration has launched a criminal investigation into Chair Jerome Powell. This move has sent shockwaves through financial and political circles, raising questions about the future of the central bank's independence and its ability to make decisions free from outside influence.
Many observers see this investigation as a direct attempt to pressure the Fed on its interest rate policies, challenging the very foundation of its autonomy. The debate has spilled over into Congress, with lawmakers fiercely arguing over the appropriate boundaries between the White House and the central bank. Public protests and heated media coverage have only intensified the spotlight on the Fed's actions.
The independence of the Federal Reserve is widely regarded as essential for maintaining stable economic policy, allowing it to act in the nation's long-term interest, rather than responding to short-term political pressures. Without this independence, the risk of erratic or politically motivated decisions increases, potentially undermining confidence in the U.S. economy. Prominent business leaders, including Jamie Dimon, have spoken out forcefully in support of an independent Fed. They warn that political interference could destabilize financial markets, disrupt investment, and ultimately harm economic growth. Their message is clear. The central bank must remain above the political fray to ensure stability. If the Fed's credibility is called into question, uncertainty about future monetary policy could rise sharply, rattling investors and making it harder for businesses to plan ahead. The mere perception of political meddling can trigger volatility in the markets, as traders react to the possibility of unpredictable policy shifts. The ongoing investigation adds yet another layer of complexity to an already volatile market environment. Investors are now forced to navigate not only economic data and earnings reports, but also the unpredictable impact of political developments on central bank policy. As a result, market participants must weigh both traditional economic indicators and the growing risk of political interference, making investment decisions more challenging than ever before. With the integrity of the central bank hanging in the balance, the outcome of this political battle could have far-reaching consequences for the US economy and global financial markets.
Commodities are telling their own story as stocks pause.
Oil prices have pulled back after a recent surge, with Brent and WTI both down 0.8% following a surprise build in U.S. inventories. Venezuela's resumed exports and rising U.S. stockpiles are weighing on prices, but geopolitical tensions in Iran are keeping a floor under oil.
The market is caught between supply gluts and fears of disruption, making oil prices volatile. In contrast, gold is hitting new record highs, surging past $4,740 an ounce. Safe haven demand is strong, fueled by Fed rate cut expectations and global uncertainty.
Gold's appeal grows as interest rates fall and geopolitical risks rise. Investors are flocking to gold as a store of value amid market turbulence. The divergence between oil and gold highlights the market's crosscurrents.
For investors, today's market is a tug-of-war between short-term headwinds and long-term positives.
The pullback reflects real concerns: bank earnings, regulatory threats, and a cooling rally.
But easing inflation and the prospect of Fed rate cuts remain powerful tailwinds.
Volatility is normal as the market digests new information and recalibrates.
The key is not to overreact to daily swings, but to focus on broader trends and your own investment goals.
Diversification and patience are essential in navigating uncertainty. The fundamental drivers of the economy and corporate profits remain intact. Staying informed and focused on the long term is the best strategy for weathering market storms.